No matter how sophisticated you are, no matter how rich you are, no matter how much you know, no matter how much experience you have, if you're making investment decisions without adequate, reliable information, we're not going to have the efficient formation of capital, and we're not going to have effective securities markets. And of course, the biggest concern is there's going to be sort of creating an atmosphere for fraud and misconduct to thrive.
Okay, so let's start with a somewhat provocative question. Why should anybody care about this?
Well, I think it's really important to understand that a private securities offering where there's not mandatory disclosure used to be the exception. Now, more money is being raised in private markets than in public markets. So if we're relying on an SEC oversight of securities offerings to protect investors' interests and to ensure accountability, aren't really going to function anymore. So a philosophy underlying our securities law and our regulatory system is that of disclosure. So the basic idea is that the government doesn't pick and choose who can sell securities to investors, but it seeks to ensure that investors have adequate information to make that decision. So if the entire regulatory system for the securities markets in the US is based on disclosure, and then we decide, well, most of the money raised doesn't have to comply with those disclosure rules, then the system really starts to fall apart. No matter how sophisticated you are, no matter how rich you are, no matter how much you know, no matter how much experience you have, if you're making investment decisions without adequate, reliable information, we're not going to have the efficient formation of capital, and we're not going to have effective securities markets. And of course, the biggest concern is there's going to be sort of creating an atmosphere for fraud and misconduct to thrive.
So you tell the story of the deregulation that has happened, and in some cases you tell the story of why it happened, meaning the lobbying that was behind it, but it's not always clear who did it. Was it Congress? Was it actually the SEC? And was this all lobbying from private market aficionados, for lack of a better word to call them?
That's a very good question. And the answer to that question is it was both. It was Congress and the SEC, but almost all of the time when the SEC is taking those steps, it's at the behest of industry interests, either lawyers for Silicon Valley, lawyers for banks, lawyers for brokers and dealers saying, hey, can we just have this tweak? Can we just have one more tweak? What about one more tweak? And pretty much the exceptions begin to swallow the rule of disclosure when selling securities to investors, whether in public markets or in private markets.
So can we go in a little bit in details on those two steps that were small from the apparent point of view, but were very substantial from a practical point of view, the 1996 reform and the Jobs Act? Both these were approved by a democratic president. Mm-hmm. So this idea that deregulation take place only under Republicans, etc., is a myth. And to some extent, Trump is only the last step in a long stairs that has been walked down by both sides of the aisle. And second, I don't know if you ever seen, but I was shocked once I saw there is a video on YouTube by this venture capitalist, very smart venture capitalist, Ravi Navakant, who explains how the Jobs Act was passed. And he basically said that it's all his creation, that he lobbied, explain how he lobbied, what he did, and how he got it done. So right. when Bethany was asking the question, who did it? I said, oh, actually, in this particular case, there is the smoking gun. There is somebody said, I did it. I'm proud of doing it. But please explain to our listeners why those two steps were so important.
The first statute you referred to was the 1996 statute, which is the National Securities Markets Improvement Act. What the statute did is it lifted the cap on the size of private investment funds and said you can be as big as you want and still avoid registering with the SEC as a mutual fund. The capital, the assets under management in private markets started to soar from just about, well below $1 trillion in 1996 when NISMIA was adopted to, in 2025, more than $17 trillion. And so startups that used to have to turn to public markets to raise the money that they needed could now find that money in private markets, because there were so many private funds and they were so big and there was no cap on their size. So then startups started to grow larger in the private markets. I think Facebook is a very good example of that, where it grew very large. It had a $1 billion IPO. It was one of the first $1 billion private companies, or private startups, I should say. But even Facebook had to face the reality of becoming a public reporting company, because there was a rule in place at that time that said if you have 500 shareholders or more and you have $10 million in assets, then you have to register with the SEC and become a public reporting company. So Google and Facebook reportedly went public because of that rule, because they had reached that 500 shareholder threshold. They decided, well, we might as well just do an IPO because we're going to have to provide those reports to the SEC anyway. So you mentioned the Jobs Act of 2012, which was really, a product of lobbying by Silicon Valley. And what the Jobs Act did is it took away that 500 shareholder threshold, changed it to a 2,000 shareholder threshold, but they excluded employee shares from that count. So since startups compensate their employees with equity compensation, it was the employee shareholders that were typically the ones that were pushing those startups over that 500 shareholder limit. So if we eliminate the counting of employee held shares, companies could basically stay private indefinitely, and that's what startups started to do.
Why? I mean, I guess I always thought that the reason that more companies were staying private for longer and the reason this was happening is that insiders could extract more of the gains when companies were privately held. But you point out in your book, it's all our money at the end of the day. In other words, most of the money going into venture capital funds is from the underlying money is from individual investors. So if gains are being extracted, then we're getting the gains. And so what's the point of this? Is it that there is more fee extraction along the way? Because if you think about the fees, for example, that a typical venture capital fund charges, it's far higher than the fees that an index fund would charge. So is that the reason for this, that there can be more fee extraction? Why would the industry push so hard for something that seems to be not so obviously in their favor?
So if you're going to be a financial manager or an investor, you would rather be in the unregulated markets where you can charge higher fees and take bigger risks than be in a regulated mutual fund, for example. So that's one reason. And then in terms of who benefits, like, do we actually end up benefiting? Well, it's our money, public money. Let's say it's Massachusetts pension fund money. If I were investing directly in a public company, I would keep most of the gains. Whereas if the money is being funneled sort of through public pension fund, a lot of the fees, as you mentioned, are going to the managers, and a lot of the profits, a lot of the benefits of the company, a lot of the value that's being built is going to be extracted by the founders and the earliest investors.